The Federal Reserve is going to reveal a lot of information about what they're thinking with regard to QT and interest rates over the next week. Thursday at 4:30, they release their balance sheet, which will tell us whether QT has been paused or continued. Last week, there was no decrease in the balance sheet, so QT was on pause last week. Next Wednesday, they talk about the federal funds rate and whether they're going to increase it 50, 25, or 0. That will also tell us a lot of information about the Fed's thinking with regard to the current crisis versus the inflation. Let's talk about the crazy week. So Silicon Valley Bank and Signature Bank were both seized by the FDIC. These companies had run into problems primarily because of depositors starting to pull funds. But before that, the companies were really broken last year when interest rates shot up and they incurred billions of dollars in losses on their bond portfolios. As interest rates go up, bond prices go down. And these companies both took big hits. Now, in the mysterious world of financial accounting, they were allowed to basically mark these bonds as held to maturity, so they did not have to run these massive losses through their income statements. And this is basically an accounting fiction. They did lose billions of dollars, but they just weren't going to recognize it, saying, well, we're going to make that up over the term of the years, which could be anywhere from 5 to 10 to 20 years. Some of the bonds were down, from 100 down to 20, as rates went from under 1% to, the 4 to 5% neighborhood. So big losses in these companies' portfolios. This is the tip of the iceberg when it comes to banks and other financial institutions like insurance companies. There are hundreds of billions of dollars of unrecognized losses in their held to maturity portfolios. This is not really being talked about as much as it should, but that was actually the root problem to what happened here. So when you have all these real losses that you have not recognized, you end up really decreasing your book value, your asset values, and you're not reflecting that in the financials, but you really are in a far worse shape financially. So the banks and a lot of the insurance companies are in that particular boat. So weak financials. So we do have the issue of the government, FDIC, Federal Reserve, is trying to address these issues and try to prevent this from becoming a systematic risk. So what they've done is two things. First, the FDIC has come out and said, Silicon Valley Bank and Signature, all of the depositors, even over $250,000 of the insured deposits, will be made good by the FDIC. And in addition to that, the Federal Reserve has put together the BTFP, and that is an ability for banks to sell securities that are underwater, that have gone down from 100 when they bought them to 90, 80, even 70, and borrow from the Federal Reserve as if they still were priced at 100. So this is a bank bailout, plain and simple. Again, the Federal Reserve is stepping in to help out banks who have made egregious decisions. We can talk about whether this should occur from the good of this economy, but the fact of the matter is these companies completely mismanaged their balance sheets and to have incurred all these losses, and there should be severe punishment met out by the market to take into account at least company managements being held accountable and being fired. That is occurring clearly at Signature and Silicon Valley Bank, which were two of the more egregious, incompetent companies, banks. So we are in a situation where the Federal Reserve and the FDIC and the federal government are reacting to this situation. The interesting thing is this, held to maturity accounting gimmick is also being done by the Federal Reserve to a large extent. The Federal Reserve has incurred over $1 trillion in losses on its balance sheet that they have also not marked to market. So there's a fictitious, but $1 trillion for the Federal Reserve, even though they can print money, that's a lot of money. It also means that the money that they have printed is actually backed by less other assets than just their ability to say, oh, this money is money good. So it definitely is destroying the value of the dollar, which is a longer term problem. The portfolios, should have been mark to market. It's a strange accounting gimmick. Transparency would actually probably have helped prevent the magnitude of these losses. I mean, the banks and the financial institutions literally have over $100 billion in unrecognized losses. The Federal Reserve has over $1 trillion in unrecognized losses. These are just staggering numbers. So now that we've had the bailout, now that we've had those two programs put in place to help save the banks again, prevent a run on the banks, what happens now? So QT might be over. Fed fund rate increases might be done. If those two things have occurred, stocks have probably already seen their lows. And we need to start getting more aggressive with investments. The market seems to think that the Fed fund rate increases are over or nearly over this month. You look at Fed funds rate and how they've reacted. There's been a huge change in the shape of the curve here over the past week as this problem incurred and then the bailouts began. We're going to find out a lot of information as far as what the Fed is doing and what the Fed is thinking this week. Thursday at 4:30, the Federal Reserve releases its balance sheet. We're going to find out whether QT, quantitative tightening, continued as promised and planned, or did they go on pause given the chaos in the marketplace this week. It's very difficult to say what will occur there, but we'll get a lot of information about what the Fed is thinking when we check in on that on Thursday at 4:30. Next week, we have the Fed meeting, and they're going to announce federal Fed funds rates. And here again, the inflation rate in the economy would indicate that Fed funds rates should go up 50 basis points. That would still put them below inflation. And really, you're not in a tight Fed funds rate environment, at least until you're above inflation. So that is something to keep an eye on. They may take a look at the situation with the mini banking crisis that's unfolding that they're trying to stem and say, okay, we've already broken something. Let's just go 25 basis points to give the market some credibility that we're concerned about inflation, but that we recognize there are some problems in the financial institutions. And then the third option would be they do zero. They say, oh man, this is a bigger problem in the financial institutions than we imagined. And if we keep pushing, some of these financial institutions are going to continue to have a problem, and the magnitude of our bailout is going to have to increase. So let's just pause here. So with that information, we're going to know sort of what the Fed is thinking. There's a very real possibility that we know that QT is over and Fed funds rate increases are nearly over by Wednesday of next week. So stay tuned. It's a very difficult environment here. Stocks are still very overpriced versus interest rates. The economy is clearly starting to slow. You're seeing massive layoffs, especially in the tech industry. You still have lots of tech, NASDAQ, innovation companies that are burning through cash, making no money, will never make any money, and have multi-billion-dollar market caps. Those probably are still heading toward zero, or at least down dramatically, where they'll be gobbled up by somebody else for their technology. But there's still a bubble that is partially burst, that's been reinflated since January 1st. There's been a huge rally in these unprofitable cash-draining companies. So there still could be another leg down with those. The reality is no one knows what's going to happen here. I don't know. Nobody really knows what the Fed's going to do. We're in a very odd situation. Quantitative easing, which started in 2008, is unprecedented. It was an unprecedented experiment and basically culminated last spring. And the Fed's balance sheet went from $800 billion to $8.9 trillion. It went up 11-fold. That's just crazy. I mean, the fact that this actually occurred and, without things going, inflation really taking off was quite mind-boggling. Now we're doing another experiment where we're going to try to shrink the balance sheet, quantitative tightening. So we've shrunk it a little bit. We're down about $600 billion, $500 or $600 billion, and with the goal of trying to shrink by about $1 trillion a year. And we're only partially into this. So the reality is the process as it unfolds is going to be potentially painful, but also unknown. We don't really know how the Fed's going to react, what the government's going to do to force other activities with regards to the unwinding of the balance sheet and trying to unwind the inflation problem. But where we are today with Fed funds rate under inflation, that's not really tightening, and that's really not fighting inflation that much. With the Fed possibly going on QT pause, that would not be very good for inflation and bringing inflation under control. So I think in the very near future, we're going to see what the Fed is thinking. We're going to basically have the flop this Thursday, where they let us know whether they continued QT or did they actually pause. They did pause last week, so 2 weeks in a row of pause would be pretty significant. And then next week we see what they do on the Fed funds rate. Do they pause on the Fed funds rate, or do they actually do a modest increase? Those two pieces of information are basically the flop in the river, and we'll all be able to see what's going on, and we'll have a clearer picture of how we should position portfolios. Right now, I have an inordinate amount of cash still. I think that you want to be nimble here. Depending on what the Fed does, you may need to reposition your portfolio pretty dramatically. If QT is over and Fed funds rate increases are over, you need to get more toward an inflationary bent. If they're continuing on that, you want to continue to remain cautious. So that's what I'm doing with my own portfolio. Please remember, this is not investment advice. Please check out buildingbenjamins.com, where you can see our full disclaimer, and you can also sign up to get email and text alerts sent directly to you so you get this information on a timely basis. Hope you find this information helpful, and have a great day. Thank you.